and welcome, welcome, welcome. We're going to try to make this interesting for you. I'm certainly happy to be here. This is not my first time at Rosalind Franklin, so thank you for inviting me back. I think I mentioned to you before that my daughter-in-law was in nursing school, and she did graduate this past fall with her RN from Chamberlain. So we're very proud of her, and I have all of you in my heart when I make this presentation that I really care about you and what you're doing for the community. So thank you for doing that. I wanted to start off with that. Next, before I get into the formal slides, I wanted to do a quick icebreaker with you, if that's okay. I can't see you all, but maybe you could send a yes, yes, yes to Hannah if you can answer the questions. Let's just ask you a few little questions and kind of get you rolling into this. So how many people out there know someone who makes a high income? And let's say that's a high income over $100,000. How many people know that person? Hannah, how many hands have we got up there? And thank you, Farhana, I see you. I only got two, so there's only two of you out there that know anyone that ever made more than $100,000 of income.
There's a few people coming in the Q&A, and then I enabled the chat for this one too. So we got a few more people that said yes, they do know. Hey Nancy, sounds like you're cutting out. It seems like it's choppy for a few people.
Okay. From the first group, if we have people that are making more than $100,000 a year, how many of you know people that complain about not having enough money? So, hey, Ahmed, Azib, I see you there. So we know people that make more than $100,000 a year, but they are complaining about their money, and they have some fears, really, about what they're going to get. How many of you know people that make a lot of from 35 to 65,000? My dad had, when we had 7 children and 5 was to college, you know, so I'd have to say that he was reasonably successful on a reasonably low income. So my experience, this experience, you can lower your hand, what that tells me is that it's not necessarily how much money you have on your payroll, how much you save. I can tell you after 30 years as a financial representative that it's how much money you save and how well it's earned that is more indicative of financial success than how much money was on your payroll. Stay with me. We're going to talk about what of their success. So I'd like to say the first principle is about your spending habits and being able to pay yourself first. Trying to advance the slide, come slide here. And I clicked the little button, there we go. I may have clicked it twice, it may advance too far. So there's a book out called, she also made a version called Smart Couples Finish Rich. And different ways that we have to spend our money. And David Bach wrote that book. It was about $5 for a cup of coffee at Starbucks. So he actually calls it the latte factor. And he says, imagine that if you had not had that coffee 6 times a week and you actually invested that money, you might, if you had invested your money and gotten a return, that you might have something to live on. And so he said, okay, what if you could take 5 purchases a week and $55,000 for you when you're 60. If you were willing to stretch a little farther, or maybe there's two of you at home and you can save $75 a week at a 4% rate of return, then you could end up with $165,000 out there in the future. This is money that you're going to need to do things with. If you're able to forego enough, or you have enough income to save $125 a week, at 4% rate of return, you're going to end up with $276,000. Interesting number, because that $276,000, each one of us needs retirement to pay for our uncovered medical expenses. Isn't that interesting? So that's premiums, dentist, eyeglasses, and other things that of us could have a bill of as much as $276,000 for the retirement. This is money, it's uncovered. By where are you going to get it? The other question I'm going to see about this slide is the banks are very low today. The interest rates are very low. Where are you going to account for that rate of return? That might be the difference between saving and investing. First way to start, if you don't already have this done, and many of you probably do, is to get a statement savings account. You can do it online. You can do it at your parents' local bank. I want you to use what you want to every time and always to seek interest earning accounts. Do not let your money sit at the bank and not earn interest. So what we do is also, when I see this term statement, I hear myself saying, check your statements regularly. If I were to ask you to raise your hand, how many actually look at your financial statements? Very few of you would raise your hands, and I would still do that for a long time. But if there are mistakes on your financial statements and you don't correct them in a given amount of time, often it's as short as 3 months. It could be 6 months. If you don't correct something that's wrong, you own it. And the best thing to do is to check your statements at a minimum of every 3 months. You should be checking your banking statements, make sure all your deposits are recorded correctly, that no one accidentally slips some money out of your account. And we know with the internet that is possible that can happen. The next step up in savings at most financial institutions, banks, money markets, banks offer money markets, brokerage houses offer money markets. So what are they and how? A money market is similar to a checking or savings account at a bank, except that it's a set-aside account where you have access to the money if you want it, but you probably won't use it. You probably won't. And if you're not going to use it, they can give you a higher interest rate. They can give you checkbook access to a money market account, but normally in order to keep the higher interest rate, they'll say you can only write 2 or 3 checks a month or no more than 2 or 3 checks. Each institution has their own way that they do it. Fidelity also has money markets. The brokerage houses have money markets, and they also have checkbooks. And each one you would want to read the account documents that to show you how interest is calculated and how they want to pay that. Now, you probably don't have enough money yet to be thinking about a money market, but in the future you will. So this is a good time to learn, to look these up, to start 2 or 3 of these smaller accounts and get them in place so that when the money comes flowing in, you don't have to be confused about what is the next decision I should make. The first decision you should make is to have a savings account, and the second decision you should make is to have a money market account. Those 2 accounts should have enough funds in them to cover 2 to 3 months of your basic expenses. Now you'll hear 12 months, 16 months, 18 months, but if I tell you to save 2 years of expenses in a money market, you're never going to get there. So let's start with 2 to 3 months of all of your monthly expenses in between your money market and your savings. And if we can do that, then you can gradually increase it. But you have to start somewhere, and I don't want you to get discouraged and not do it, right? So if we understand that there's checking, savings, and money markets, there's another level on the bank side, and actually brokerages often offer these too, and that is a certificate of deposit. Now, you may have heard about this, you may already know this, so I'm sorry for those of you who are independently wealthy and already know this, I apologize ahead of time. But what the certificate of deposit does is you set aside a certain amount of money. Usually the minimum's about $500, but they're very low minimum and very low risk. The defining factor is how long the institution will keep your funds. So if they're keeping your funds for 6 months, you get a rate. For a year, you'll get a higher rate. For 18 months, you'll get a higher rate than that. This is money, say, look, we're engaged now. We want to get married in 2 years. We don't want it in the stock market. Let's put it in a CD so we know that deposit for our wedding is going to be there when we need it. So the benefits are that it helps you be disciplined and not dip into your funds when you might need them. The trade-off is you don't get to dip into that until a few months out. Now, you will have access in an emergency. They will just take away your interest, probably in a small penalty, if you have to break a CD. But if you don't do it, then you're looking to your daily income to make large purchases, and that's not a great idea. It's much better if you know ahead of time, we're going to make a large purchase. You start setting money aside for that purchase. We want a new couch next year. You make a 1-year CD. And if everything has gone well, then you go ahead and buy that when the time. Right now, interest rates are relatively low, making CDs pretty unattractive, but it's still a good habit to get into. And if I were a young person just starting out with loans and other things going on, I'd have some 6 months, 1 year, 18 months, and maybe some 2-year CDs. Even small amounts, just have it on your budget, and you just keep working it with larger and larger numbers as the CD comes due, because they will come due. If you do a 6 month, a 1 year, and a 12 month, you've got fresh money coming back at you every 6 months. They do come due, and that's actually a good feature of CDs. Just briefly, I want to explain how compound and simple interest works. So naturally, you're not the only person making money on your money, right? So the banks have to figure out a way to calculate how much interest they're going to give you. And there's 2 ways it can be done. Compound interest obviously works in your favor, but simple interest is this. If you start out with $1,000 and you're going to earn simple interest, they told me 6%, which is a long time ago, but 6% interest in 1 year on $1,000 is $60. At the end of the first year, you have $1,060. At the end of the second year, they would give you $60 again, and they give you $60 every year until they give you your principal back. That's simple interest. If you have compound interest, which is the one that should be sought, you would put $1,000 in, and at the end of the first year, they would give you $60. Now, from the interest calculating point of view, you've got $60 at the end of the first year. They're going to give you 6% on $1,060, which means the second year, instead of $1,120, you'd have $1,123.60. So just be it said, and the longer you have to go, the more benefit you're going to see from compound interest. There's a few other factors. There's a few things we want to remind you about when it comes to having a savings account. Again, they're going to calculate an interest rate for you. Savings accounts in banks are FDIC insured. CDs are FDIC insured. Money markets can be, but they're not always FDIC insured. So if you go into a money market, make sure you read the prospectus and who the insurance is with. If the insurance is with the FDIC, it can be with another organization. So there's factors also that can affect how much money you have in the bank. Don't be afraid of these, because if you don't have savings because you're afraid that they might charge a fee, then you're the one who loses out because you don't have the savings. But there can be fees charged, just like on your checking account. If you go under a certain balance, they can charge a fee. If a CD is taken out early, they can charge a penalty. But again, you're not going to take it out early unless you have an emergency. What you need now, what you need today, is that for long-term money needs to earn long-term rates. I have seen in my practice, clients keep money in a checking account. And I go back and look, I say, well, how long has this money been in there? And they'll say 10 years. And they'll say, well, you didn't earn any interest for 10 years on that money. And they'd say, well, I might have wanted to use it. I might have wanted to use it. I said, well, let's discuss what you might have wanted to use it for and see what the best vehicle for that money is. So you don't want to have short-term money for a long-term program. And just to point, online banks can be just at some of these large online banks, just so you check them out and make sure that they have the good charter and FDIC coverage. They can work for you just as well as the brick and mortar banks, and the brick and mortar banks are feeling the pain. One of the ways that the government protects us is with financial services. It's called the Truth in Savings Act. Just real quickly, when you open a new account with an institution, they're going to send you this great big package of data. And it's going to include your fees on your deposits, it's going to include your other terms and conditions. And since the fees of the Truth in Savings Act, banks have had to charge give clients interest based on a 365-day year. In the past, banks were only giving us interest based on a 360-day year. So there's always someone watching out for us out there. Another step to know, a principle, and it's sometimes, so the first principle we talked about is paying yourself first. The second principle is understanding the importance of compound interest and how it can help your money grow in the long run. The third principle I want to talk about is called the Rule of 72. You may have heard it. Raise your hand out there if you've heard about the Rule of 72. Any hands raised? Everybody still with me? So the Rule of 72 is important because it shows the value of compounding interest on your money over time. Really, if you can take the rate of return you earn on your money and divide it by 72, or take 72 divided by the rate of return you earn on your money, it will give you how much time it will take for your money to double. And an easy way to think about this example is 7.2% interest rate. If you divide 72 by 7.2, it gives you a result of 10. That means that at 7.2% interest, if I put in $10,000, it'll be $20,000 in 10 years. You can also imagine that same $10,000 would be $40,000 the next 10 years, and that it would be $80,000 the next 10 years. That's the power. Now go back to the big blue box, the 72. If you're earning in your bank account 0.5%, let's just say 1% to make it easy, 72 divided by 1%, left in a bank account, 72 divided by 1%, it would take your money 72 years to double. And I don't think most of us have that much time for our money to grow. So maybe we got to learn some of the other concepts that go along with finding success in your finances. So the first step, oops, everybody still with us? The first step into the different financial markets is the existence of a group of securities or asset class called bonds. When you purchase a bond, so instead of taking your money and deposit at the bank, you go through a brokerage house or directly through a transfer agent, you lend money. A bond is a loan where you're lending money to a corporation, a village, or federal government. As a loaner, you will receive regular payments of interest unless the bond issuer defaults. The buyer buys bonds. You buy the bond in $1,000 increments. It has a fixed rate of return for a fixed amount of time. And when that time is up, they're supposed to have matured the bond and give you your full face value back. So that's how in a little bit more detail, a corporate bond is sold by private companies to raise money. So a lot of them are issued by companies when they're going out to start a new product. They will issue bonds to raise money to pay for the research, and they expect to pay the bondholders back when the project or whatever it is comes through. A municipal bond, on the other hand, is issued by other non-federal government agencies. So that can be cities, villages, school districts. And because they're for general public purposes and purpose uses, like the Chicago Bears issued a bond when they rebuilt the stadium many moons ago. Because it's a public interest, do not get charged at the federal level. So if you own municipal bonds and there's a 3 or 4 or 5% interest, then and you earn that interest, it does not get taxed on your tax return, which is a good thing. I remember the days when municipal bonds were 8, 9, or 10% and not being taxed. That is not the current environment. We're more in a 3 to 4% environment, but still 3% that's not taxed is a better argument for you than 2% sitting in a bank that's taxable. Some bonds you may have heard of, your family may have some for you, EE bonds, I bonds. They can be saved in small increments or large increments. And there's a couple of different ways, I think we're going to show you there, of how federal bonds work. Now, generally, people find that federal bonds are the safest. They perceive them to be the safest, and that is because they are backed by our taxing power, the taxing power of all of us. All right, so if you have a question about bonds or bonds in general, send our hostess a questionnaire. Again, this is the basics of investing class. So I want to make sure that you have an idea of all the concepts that are available to you. We all know how important fundamentals are. So these are the fundamental building blocks of financial services. The next one is one that you probably are familiar with, and it is the most prevalent experience of the public in financial markets, and that is mutual funds. Now, mutual funds is basically where investors money is gathered together, and the professional manager chooses the individual stocks or bonds that are going to be in that program. Each program has a prospectus that details their objectives and what they are going to put into that fund. So never, never, never put your money in a mutual fund unless you know what the manager's objective is and what it is that he's going to be investing in there. So these are the general direction, and oddly enough, there are many more mutual funds than there are individual stocks, which is fun. But these are the basic different types of funds. So a balanced fund would have some stocks and some bonds in it, and generally more stocks than bonds. It's usually about 60-40. When you see the term balanced fund, they're going to lean to more stocks and some bonds, and the bonds are there for balance. That's why they call them balanced funds. A global bond fund means that they're buying bonds from around the world outside of the United States. Global is outside of the United States bond fund. A global stock fund, as you can imagine, means that they're buying stocks from outside the United States. Now, I had this experience many years ago. I was with another firm, and they were really big on global stocks. Now, think about this. If you pick up almost anything in your home, it's made somewhere else. And my favorite chocolate, my favorite soda pop, my favorite yogurt, a lot of these things are made outside of the U.S. If you're young and you're smart, in the long run, you're going to include something of a global stock fund, even a small amount, but don't forget them because everything in your house just about came from somewhere else, not here. There are growth funds where they're looking for stocks that are on the go-go, and they are looking for stocks from just about anywhere in the world that are expected to grow. There are income funds that are presumed to be safer than all these other types of funds because they buy only bonds, and bonds have maturities where you get your money back and specific maturities. Income funds do not have maturities. You have to buy in and out of them. They don't have maturities like regular bond would. Then there's industry funds. Now, who can't imagine an industry fund would be one like industry funds say that everything that's in that package is pretty much related to the industry that's chosen. And again, Fidelity has a huge list of those. Vanguard has a huge list. Charles Schwab has a huge list of industry funds. If you just type in something you want to invest in, an industry fund is much safer than just going out and say, hey, I know there's a new startup. I really like cell phones. I want to be in a cell phone startup. Buying one stock is much for the group and just taking advantage of the growth in the group. Municipal fund by name, the funds that are of cities, states, school districts, other things that are of public use. And since municipal bond funds have municipal bonds in them, the interest that you earn there is also tax-free. That's going to be important. The older you get and the more income you have, tax-free is going to be an important concept. Regional stock fund. This is interesting. You don't see too many of these anymore, but with a regional stock fund, you could say the Southwest or the East Coast or the North. You could also say Malaysia. You could also say the Asian corridor, things like that. Regional just kind of by name picks a geographic region that they were investing in. Again, each one of these types of things, a mutual fund is you're joining their group. They already have stocks and bonds in there, and you're going to get a slice of the pie, certainly if you keep it long enough. Some of them pay dividends, some of them don't. Now, the next category in risk and certainly in knowledge, you would have to have some time to do a little homework. Risk or knowledge is the category of stocks. And some of you are familiar with stocks, probably most of you. Some of you may not be, so let's go over this. Stocks represent ownership of a corporation. So if you give money towards Apple, these are not Apple bonds that they're going to pay you back in a specified amount of time. This is represents ownership and made and shares will go higher. They will pay dividends, which is very nice. And dividends are usually paid quarterly, which you can then reinvest or do somewhere else. Stocks can generally have larger profits over time, and they're going to see a lot more geometrical growth than a bond will, because what are we taking here? When you own part of a company and it's not a loan, you're taking a risk. So in most financial markets, risk and reward are tied. If you win the advantage of owning a stock is if the general goes up, the gain can be quite a bit. Stocks can hold a trade date plus 4 days to get your money back when you need it. The disadvantage is if that company has a hard time and can't do what they promised they would do, the stock can go down and you can lose money. So stocks can be bought by you individually through a brokerage. You can do it online. You can call your parents and see who their advisor is. But you want to, stock selection is pretty tricky and takes some knowledge and some homework, but it can be very rewarding if you have the time and interest in doing that. We're kind of winding down on the content part here, so I hope I've been giving you some food for thought and you're coming up with some good questions for me, because I think that if I answer a couple of good questions from you, then you will feel like we've had some good time together today. Okay, an often overlooked aspect of investing is real estate. And what I want to say about real estate is that I'm not talking the flip or flop guys. I'm not talking going out and doing this as a hobby. What I'm talking about is your home, the home that you're going to live in. And there's different ways to invest in real estate, but the most significant one, when you look down the street of individuals who have the same jobs, the same income, the same number of children, and apparently the same needs, those who have bought their homes and paid them down early end up with more wealth than the same family who didn't, who takes mortgage after mortgage after mortgage and keeps the payments going long term out into their, retirement years. That family has more problems with money than the family that paid off the mortgage on time or early and just continues to live in their home as an asset and takes good care of it. It's also a great hedge against inflation. Now, you guys might not remember this, but I do. The first time I put a tank of gas in my car, it was 39 cents a gallon. And the first time I went to the movies, it was 75 cents. And I could actually, at that time, see the movie twice if I wanted to. So 75 cents for a movie is now $10, $12, $15 to go like dinner. Gasoline had gone to $4.50 and now it's $2 something. When I started, it was only 39 cents. Owning real estate is a good hedge against inflation. This same house here, let's say this house had been 45 years old. It's not, but my parents bought their first house for $25,000 and they sold it for $79,000. And the second house they had for $79,000 and sold it for $325,000. So you kind of know that over time, we have this in the back of our head that real estate can be a big wealth builder, and it is a big part of your security, personal security and financial security. If you need the money in a hurry, it's not going to be the money that's in your house, because then you're going to have to go for a second mortgage or some type of loan against the house. But it is a great way to build long-term wealth. And when you're getting ready to retire, you can downsize into a smaller home and have some extra cash for your fun things that you want to plan to do in retirement. Just so you know, profits from the sale of your home, the first $500,000 for a couple is not taxed. The first $500,000 for a couple is not taxed. So if you made $500,000 on your homes over the years, then that's all yours. If you made lots and lots more than that, then we'd have to talk to your tax advisor and find out. Okay, real quick, we is where are you going to save that? And I'd like to say that in addition to your home, the second, sometimes first, largest asset that a young person's going to have is their 401k. And in the absence of 401ks, IRAs. So if you guys end up working for a hospital, or the closest thing to a 401k, they might have a 403b. It's going to work for you very much the same. So if you work for a non-public organization that does not have a 401k, they might have a 403b. If you go to work for someone who doesn't have a retirement plan, don't work for them very long. Find someone who does. And also, you can do an individual retirement account for yourself. Start right away, even if it's $25 a month. Remember, we go back to compounding. Every little bit helps. And if you don't put it in there, where are you going to be? So the types of retirement plans that are most typical today, we're talking about that 75, 150, 200 a month that you have. If they take it right off the top of your payroll, you won't worry about it. It'll be built into your budget. It'll just be there for you to grow. Many, many times, most of the time with the 401k, there's an employer match. And what that does is ours is 50% up to 6% of our income. That's an automatic 50% return. Why wouldn't I do that? If I give the firm $100, they chunk in 50, and I'm off to the races, ready to make selections. So if you have any questions about 401k plans, I can go more into that. but basically everyone has access to IRA. And if you are working with the 401k, they may restrict your some things. There's some restrictions. Certainly, there's no plan. You make one for yourself, and you want to talk to a financial advisor about setting up an individual retirement account versus a 401k, or in your case, because most of you are medically related, you will have an option for a 403b. And you can also have a retirement plan for a self-employed person. Do not make the mistake of thinking that someone else has to do this for you. You can have a retirement plan even if you work for yourself. You just have to call one of these advisors who sets them up, get the paperwork, and start doing your EFTs to start saving for your retirement. So this is a little bit more, is again, motivation. And if we go back to David Bach's book, The Smart People Finish Rich, I think that may be even where they got some of these numbers. Small investments done early, if you can squeak them out early now, before you get married and before the kids, between 20 and 30 for 9 years. They only put in 2,000 because the limit used to be 2,000 and now it is 6. You can do 6,000, so we can triple this. If they only contributed for 9 years and left it in there till they were 65, they'd have $579,000. That's impressive. If they did the current limit of $6,000, they'd have $1.5 million plus in a retirement account only for contributing now and then stopping. It's impressive. If you wait, there's a cost of waiting. To get anywhere near close the same amount of money, you would have to contribute $2,000 every year between 31 and 65 to achieve even close to the same amount of money. So what I'm suggesting here, that is, invest even a little bit. $2,000 a year is not a lot. Do it consistently and leave it in there. That can do as much for you as if you were to contribute later. And you're going to have to contribute more money if you start later, and you're also going to have to contribute a longer period of time. I hope to see some questions about that one. So we start designing the different programs are available and what some of the particular characteristics of those programs are. So right off the bat, I think this pretty much summarizes what we talked about. Savings account, the money is immediately available. There's no risk involved, but the return is also low. There's usually a very low minimum balance, easy to do, but whatever you do will be taxable. A certificate of deposit, on the other hand, is 90 days or longer. I've seen them up to 6 years. People aren't doing them very much recently at these low rates. They will be no risk because they're under the FDIC cap. They are low or moderate yield, which means you're going to get more than a savings account. The minimum balance can vary. I've seen as low as $300. Again, whatever you do earn on a CD, whenever you earn it, and this is another fun thing. So if I buy a CD in December and it doesn't mature until March, I don't pay the taxes on it in December. I pay the taxes on the interest on the tax return that covers the March. Corporate bonds are company bonds. They're issued from 5 to 30 years. You're making a loan to that company, but you want your money back. There is a moderate amount of risk depending on the company that you're working with. There is a better return probably than these other options, and usually they're sold in round lots of 1,000. That interest is also taxable. The next category of bonds is municipal bonds, which like that Chicago Bears bonds or the school district bonds. They're issued from 1 to 20 years. I've seen longer, but most of them are 1 to 20 years. The moderate amount of risk, and the risk in the case of the bonds, if they're backed by revenue, then they have to be paid back by taxes. So there's really, some of them are very low risk and some are uninsured. They have a moderate risk, usually in the 5,000. That's the biggest feature of the municipal bonds right here, that there's no federal income tax due on that interest. Stocks, we know we can sell at any time, even though it's best, always best, to hold stocks a long time, a year or longer, because sometimes things don't work out as fast as they do. Some stocks are lower risk, some stocks are higher. The yield in terms of dividends, two yields on stocks. One is a dividend and one is an increase in price. So you want to know when you buy them, which are you looking for? The high dividend stocks are usually lower growth. The high growth stocks are usually lower to no dividend, but you're expecting it to go kaboom and make you lots and lots of money. The minimum balance, there's really no minimum balance anymore. Charles Schwab's got $25, you can buy a part of a stock. Stock earnings are taxable. The longer you hold them, the less the taxes would be. Now, Treasury bills, we have bills, notes, and bonds, all based on how long they are. If they're under 1 year in duration, they're called a bill. If they're 1 to 10 years, they're called a note, and 10 to 30 years, they're called bonds. They're only taxable to the federal, not to the state. Mutual funds will vary depending on what it is, and retirement accounts will vary depending on what it is. So I'm not sure why that's under U.S. Treasury, but retirement accounts vary by the program. A word of caution here, and I've been around a really long time, and the more people get on the internet and the more money there is to be made, there are more creative ways for people to scam other people. And it's really sad, but it is true that you should keep yourself protected by becoming informed about investments and industries. You know, do not listen to people who call you on the phone offering you all kinds of returns. You want to talk to your parents or other trusted advisors who have made similar investments. You want to obtain information. If you want to do an investment with an organization, you need to check them out on their state and federal websites. And I can give you those if you want them, what those sites are to check them out. Again, do not buy over the phone without first investigating the situation, and avoid investment opportunities. Number one red flag, they're going to give you a huge return, 20, 30% in less than a year. And only if you come in here right now. A friend who was went online and was introduced to an investment. There was a big celebrity, very, very big, very popular celebrity touting this product and program. I told her to bring me the prospectus. I wanted to review it. After reviewing it, I told her that I didn't understand how they were making money, and I didn't understand what the backing of that promise of making that money was. And she hadn't been with the product. She did a guest advice, and lo and behold, 9 months later, it's completely debunked. And I can tell you, I have seen that happen in my career about 10 times, where people find something on the outside, or farm land, and there are a handful of bad ones. So make sure before you put any money down, you've done your homework. Real quick. Oh, that is quick. I'm going to go back to the beginning. Okay, so I'm going to go back to here and see where the questions. I know there was a few things I didn't cover, so throw it out there. If you didn't hear something you wanted to hear, go ahead and ask the question. Thank you very much for having me here today.
Yeah, definitely. Thanks for presenting. So we do have questions. So our first question is, what are your thoughts about buying multiple homes and renting them out for years and then selling them later on it to profit? Is it too risky to buy multiple homes and rent them out?
I'm always a fan. I'm a big fan of real estate. So I don't see that as a problem if you can do a couple of things. I'm gonna give you a couple of principles. If you have to put down more than 50%, if you're in a position of being able to only seen really go up. But historically, real estate has good years and real estate can also have bad years. So if you're in a position where you can afford the payment and either you are a handyman or you know someone who's a handyman who will charge you fairly, then it's an okay thing to do. I have a lot of relatives, aunts and uncles, and two of them have done extremely well in real estate. They started with small properties, very, very small, that you and I wouldn't even consider living in, but that the cash flow was good. They didn't have to put a lot of money down, and they understood the regulations. So the regulatory environment has a big impact on the price of real estate. I remember a time in the 80s, mid 80s, and you guys weren't around yet, but I remember a time in the mid 80s when the regulatory environment went very, very severe. And people who had all kinds of investments, they might put in 10% down for a $100,000 property, and then the thing went down 20%. And so that left these people because of just by regulations alone, the government decided that they weren't going to allow tax deductions for improvements on the third and fourth and fifth, level of ownership. And just by that fact alone. So if you only put in 10% and now you owe 20%, so that being said, I do agree with real estate as an income property. And I would say if you want to be able to put in 50% of your own money, I know some mega millionaires that have done it that way, and they're always at 50%. They only buy what they can afford, and the property paying for can stop paying rent. They might let you. In the current environment, there might be a freeze on evictions. There's several things that could happen, making it so that you did not receive the rent that you were counting on. And as long as you're at that 50% equity level, it doesn't hurt you so much. And you can wade through that times and move forward. So my multi-millionaire real estate client owns, I say, about 96 properties, and she built it a little bit at a time, every 4 or 5 years. And when she got some equity, she would take the equity from the one property and put it in the new one. That's another discussion I'd be happy to have with you. It's a great idea, but you also have to be very, very, very careful and go in with enough of your own money that you can ride out the waves.
Awesome.
That's my
so kind of going off of like owning a home and having mortgages, should you attempt to pay off your mortgage quickly or invest in the market? Mortgage rates are very low currently, and you could probably out earn this in the stock market with a higher return.
Yeah, this is an interesting time, and forgive me if I'm displaying the wrong thing. So I'm going to rephrase that. I think that should you? My first answer is both. My first answer is both. So if you can pay off your home, and if you have the assets, $100,000 in the bank's only going to earn you $1,000 a year. So if you pay off the mortgage being 2% is, it depends on also your appetite for risk. Some people don't want to have any debt. If you discuss it and you have a husband and wife, they can have a very different view about debt. So you can always try to meet in the middle. Now let's go back to this question. Is there one person involved or two people involved?
That's a great question. See if they answer.
So I can answer. Yeah. Average returns in the market are 8 or 9%. So that if you hold the market for a really long term, even though like last year and the year before we were over 20%, that doesn't happen all the time. But this is definitely a market that you want to be invested in. So, but I guess the question is, having a mortgage and investing the difference I'm trying to see how that helps you because you still have to cover the note. So if, I'm going to pull that back around. If it's just one person and you don't mind having debt, then you take the mortgage and also try to invest. But remember, if you do pay your house completely off, you can't eat your house and you can't take an equity loan when you're in a bad position. So if I did that, I would pay off the house and get an equity loan when you have a nice income, get it all set up so that you have it for an emergency, and then go and do what you need to do. But if you try to go for either a new mortgage or a home equity line after you've lost a job or after you've been sick or after something's gone wrong, the banks are not going to give it to you. So it's better to have a mortgage and then have extra money that you can pay it off if you want to, or do what we did on the 50%. You get it down to 50% and then you're very comfortable, because if all your money is in the house, you can be house poor. And if you lose your job and you need money, you know, the bank doesn't want to give you a new mortgage at that time.
Perfect. Okay.
I hope I answered that.
All right. Let's see. We have questions rolling in. So how about this one? You mentioned that we can start our own individual retirement account. How do we do this? Do we go through a bank? And then in the and another portion of this question, how do you turn an IRA from a previous employer into an individual IRA?
Okay, two really good questions. So individual IRAs can be opened up at banks with CDs and loan papers. They can also be opened on the same type of paperwork. So obviously Prudential, Ameritrade, Prudential, all those places. So you can either go online or talk to an advisor. And you could even say, I think if you Google 10 best places to open an IRA, you can just about Google anything today. You would get some great suggestions. And I think there were even 10 best mutual funds for an IRA that you would also get some good suggestions. If you're brand spanking new and want to talk to a financial advisor, then you should call one of us. So to get you going, but IRAs are very easy to open. They were created, 50 years ago. They started them out at $2,000 a year that was allowed, and it's up to $6,000 now. But you can break that up, and I highly suggest you do, to say you can do between $2,500 and $400 a month. That comes out to your contribution. So you have to decide for yourself. Is it easier for you to make that IRA contribution? When most people do it, they do it at tax time because they've had their tax return done and their tax advisor tells them, sorry about my phone, the tax advisor tells them to go make an IRA they can save on their taxes. So most IRAs are done in March and April, but you don't have to do the whole thing at once. And you can have one with more than one institution. I'm going to grab this phone. The second part of the question was, how do you take an IRA that might have, or a 401k that might have been at an employer and turn it into an IRA rollover? And that's a two-step process. And I know some of the bigger firms try to make it as easy as possible because they don't like handling this paperwork either. But first of all, you open the IRA at the new place where you want to be, where you want to go, and they have what's called a transfer of assets form that they will decide. That's first. Second, if it's still at the original employer where it was contributed, now you'll want to go to their website and get their paperwork for a withdrawal. The paperwork will have different boxes on it as to where the withdrawal is going, and that's where you prevent the transfer from becoming a taxable event by using their paperwork. So it's a two-step process. And very easy.
Perfect. So I guess we have 3 more questions here. The average CD rates of return seem low on average. Is a money market account any better for putting money away for 1 to 4 years duration?
All good questions. All good questions. Smart kiddos there. So this is a really strange interest rate environment. And when an interest rate environment, when a 1-month CD, 6-month CD, 12-month CD, they all pay the same thing, you want to tend towards the shorter end. If they start to reward you for going longer, that's called a yield curve. So if you're in for 6 months, you get one rate. If you're in for a year, you get a little more. If you're in for 18 months, you get a little more. When there's a nice curve and you get a reward for going longer, then you invest in the longer ones. But right now, if the goal is to buy something that you want to buy something, let's say in 4 years, you know you're going to get married or do something, buy a new car or a house, then I hate to even say this because predicting where interest rates are going is a fool's game. But interest rates should start to tend higher on the longer ends later. So start in a 6 to 9 months and wait for those 1 and 2 years to go up before you go up for 4 years. That's my call. Because otherwise you're going to buy a 4 years months to a year for a 4-year.
All right, so 2 more questions. What are your thoughts on buying a home in a tax lien sale?
On my side.
Sorry, what was that?
The tax lien sale. She's asking about a tax lien sale. Okay. So what happens in a tax lien sale is that someone has gotten in trouble on their taxes, either their property taxes or, believe it or not, so the IRS is the only one. The IRS is the only one that can take your house away from you. And you have a lawyer, you can make sure that every single, during the close, that the title is completely cleared of everything. I've seen cases and heard of cases where people bought a property that was supposed to, all of the taxes supposed to be paid, and they weren't. So then those taxes will fall back onto the new owner, which is, of course, not the intent. Now, there's another program, and I'm not sure if they mean this or not. So they can tell me to stop if they want me to stop. But there's another program where you can buy the taxes. You can make a prepayment on taxes, and the owner is supposed to pay you back. That's through like the county. There's actually a website for this. You can buy people late taxes, and then you can end up owning a property if they don't pay you back. That's a little tricky and a little scary, because if you're in a position of potentially losing your home and you know you're going to lose it, I mean, I'm not sure how you would treat that home at that point. So there's 2 tax channels. If you're talking about buying on a house that's on an auction, like an IRS auction, they're selling the house for past due taxes. Just make sure you have a good attorney and that you're patient, especially right now. In the COVID environment, the government is behind on everything. When I say behind, it could be years. I've had people have a hard time getting a divorce. They've got custody issues. They've got, all types of property issues. And be patient. If you're not planning to live there right now, if you're not being, if it's not a push like, hey, we have to have a house next month, then you can get some good deals that way. But remember, and don't be surprised if the people moving out of a house that they've had taken away from them don't do something to trash it. And that's also, count on an extra 10% of expenses for that. They will trash the property if they lose it.
All right. And final question, should we, and this is a great question too, should we focus on aggressively paying off our student loans rather than putting money into an IRA right now?
That is also a great question. So I think the last time, now I just want everyone here to know that student loans can be renegotiated. So if you could get, let's say, a 2% mortgage and somehow money ended up in your hands and you use that to pay off your student loans, nobody's gonna, nobody's gonna say anything. They want to get their money back. I don't know what the new ones are this year. I think it has to be some of both, because again, I'm going to be diversified, very, very diversified. And that is that if you saw that slide, if you could put $25 a month in something that will grow now while you're young and let it ride and then pay off those other notes, look what you have later. What did I say in that one slide? Now, and then let it do its thing and then pay off the debts, because if you wait till you're 30 plus, you're going to be investing a longer period of a time and need to put in more money to get the same result. Invest now. And certainly we're talking not huge amounts. Between $2,000 and $4,000 a year should go to your investments. Use the rest for notes and things debts that you want to pay off. Certainly don't have any big credit card debt. If you're planning on having a home, right now, one debt restructure program is to get a home equity line at 2% and pay off your 15% credit cards. But don't forget that compounding, putting it in now versus later, is a huge trick. If you can't do it, you can't do it. But it is a huge, huge step in the right direction. You won't have to work as hard later. That's my answer.